Welcome back to the Deep Dive. Today, we are taking a really granular, operationally focused look at financial compliance.
Yeah, specifically for securities dealers,
Yeah.
right? Especially those operating under the Seychelles framework.
Exactly. We're diving deep into how their public face, their websites need to be engineered, basically how to make them truly audit-ready for 2025.
And we've got some great source material for this. We're leaning heavily on insights from the experts at Victoria Chartered Certified Accountants, VCCA.
That's right. We're specifically digging into their guidance, which is titled Audit-Ready Marketing: How Securities Dealers Must Nail Website Risk Disclosure and Mandatory Policies in 2025. Really practical stuff.
It has to be practical because this is, well, it's absolutely non-negotiable territory now. What we're talking about today, it goes way beyond just, general financial risk management.
How so?
Well, it's become this highly prescriptive mandate. It's set by the Seychelles Financial Services Authority, the FSA, and the industry has genuinely entered a new era where, honestly, compliance is checked pixel by pixel.
Pixel by pixel. Wow. So that's really the core of our mission today, isn't it? We're trying to distill these four mandatory pillars, you could call them structural requirements, that can, I guess, transform a securities dealer's website
Right, move it from being like a potential regulatory time bomb.
to an ironclad fortress of compliance. And like you said, this isn't a suggestion box anymore. It's about meeting these very exact, almost surgical standards that are now being enforced basically in real-time inspections.
The stakes are just incredibly high. And the reason is the whole basis for scrutiny has gotten wider. We're dealing with fundamentally two massive pieces of legislation that are driving this push for radical transparency.
Okay, what are those?
You've got the really detailed format-focused Securities Advertisements Regulations 2024. That's the new one dictating a lot of the specifics. And then there's the broader ethical standards set by the Financial Consumer Protection Act, or FCPA, from 2022.
So it sounds like we're talking about a complete overhaul. Every single element of that digital interface, it has to satisfy both, the marketing team's desire to sell
Yeah, get the clicks.
and the cold, hard logic of the compliance officer. And the VCCA guidance really emphasizes this point. Failure to meet these specific standards, it will be flagged immediately during inspections.
No grace period, basically.
Right, which is exactly why we need to unpack Pillar 1 first.
Yeah.
Because it's definitely the most visible and, frankly, probably the most technically tricky mandate to get right.
Yeah, Pillar 1 is, you could say, designed to kill that whole culture of hiding the important stuff in the fine print,
Tiny disclaimer at the bottom nobody reads.
Exactly, that's gone. This pillar addresses risk warnings and, crucially, anti-misleading statements. It dictates not only the specific non-negotiable text you must use about risk,
Okay.
but also the physical mechanism, how that text has to be delivered to the client so that it's functionally impossible to just scroll past it or mentally tune it out.
Okay, let's start with the content then. The actual words. You said it's non-negotiable text, almost like a legal quote that has to be reproduced exactly. We're not talking generic disclaimers anymore.
Absolutely not. It's laser-focused on the concept of maximum theoretical loss. The risk warning must specifically state the possibility of incurring unlimited losses that are greater than the amount deposited.
Right.
That is the full stop, non-negotiable sentence. It defines the dealer's maximum liability disclosure. It has to be there.
Okay. Unlimited losses that are greater than the amount deposited. That phrasing, it's deliberately stark, isn't it? Quite frankly, terrifying if you're a trader thinking about putting money in.
It is.
So from the regulator's perspective, why is that specific wording just so absolutely critical? Why not something a bit softer?
Because it targets the single biggest consumer protection issue in speculative trading, which is the margin call and the potential for a negative balance.
Right, owing more than you put in.
Exactly. Many clients, especially people who are new to these kinds of complex products, these restricted speculative investments, they often assume their liability is capped. They think, okay, the most I can lose is what I deposited.
A very common misconception.
Hugely common. So this phrase, mandated by the 2024 Advertisements Regulations, it just explicitly obliterates that assumption. It forces the dealer to address the absolute worst-case scenario, the potential for debt actually exceeding your equity directly up front.
So it protects the client.
Protects the client, yes. And by including this specific wording, the dealer also establishes a really strong legal defense. They can prove the maximum theoretical risk wasn't just hinted at, wasn't buried somewhere, but was clearly unavoidable stated.
Which, I guess, shields the firm from claims later on that they concealed the true risk.
Precisely. It cuts both ways, protects the client, shields the firm.
But I can already hear a securities dealer listening to this, maybe arguing, okay, but requiring such stark, almost fear-inducing language, doesn't that just deter potential clients? How does the regulator balance that, investor protection versus the dealer's basic need to attract business?
That's the million-dollar question, isn't it? And it's exactly the tension the regulation is designed to manage. The FSA's mandate, very clearly, prioritizes investor protection over easy business acquisition.
Okay.
The underlying principle, especially when you look at it through the lens of the FCPA, the Financial Consumer Protection Act, is that only those people who fully comprehend and actively acknowledge the possibility of, essentially, infinite debt should even be allowed to proceed with these kinds of instruments.
So if the warning scares off some people,
Then the regulator basically views that as a success, not a failure of the regulation. It effectively filters the client pool. It pushes it towards those individuals who genuinely understand and accept the severity of the risk involved.
okay, that makes sense from a regulatory standpoint.
Yeah.
So the content is fixed, it's dramatic, it's clear. But you mentioned the compliance challenge, then immediately moves to the format and the placement. This is where the technical complexity really spikes, you said. It's not just about putting text on a page.
Correct. The presentation, how it looks and behaves, is just as rigorously audited as the words themselves. The warning has to satisfy this checklist of visual and, importantly, structural requirements.
All right, what's on the checklist?
Okay, first, it must be conspicuous, which means, visually distinct, immediately noticeable, can't blend into the background.
Got it.
Second, it has to be written in bold text, again, making it stand out.
Okay.
Third, it must be enclosed within defined borders, like a clear box or an outline, something to visually separate it from all the other content around it.
Right, those three seem relatively straightforward, I guess, from a design perspective. Strict, but doable. But you mentioned a fourth one, the one the VCCA source highlights as being the real operational headache, the behavior requirement.
Yes, this is the big one. It must be statistically fixed, sticky, at the top of the screen.
Sticky, meaning?
Meaning it stays put. It has to remain visible at the top of the screen on all relevant pages, regardless of whether the user scrolls down or not.
Ah, okay. So like those banners you sometimes see on websites that just stay at the top even when you scroll.
Exactly like those. But this is an optional marketing flair. It's a mandated compliance feature.
And that's the killer for web development and QA teams.
It absolutely is. Because the physical placement and, crucially, the behavior of that text, the stickiness, are now explicit regulatory requirements. It cannot disappear, even for a second. If a client scrolls down a very long, very persuasive landing page, or maybe a detailed product description,
Which marketing loves.
which marketing definitely loves,
Yeah.
that risk warning has to remain persistently visible right there at the top of their screen. And typically, that occupies really valuable, above-the-fold screen real estate.
Let's dwell on that technical audit challenge for a second. Because what sounds like a fairly standard website feature, a sticky banner, is now suddenly a critical compliance point. What specific technical failures or, operational glitches is the FSA actively looking for when they audit this functionality? What makes it fail?
They're doing essentially a really thorough cross-device and cross-browser responsiveness test. Just think about the sheer variety out there.
Yeah.
You've got standard desktop browsers, Chrome, Firefox, Safari, Edge, then all the mobile operating systems, iOS, Android, different versions, and various tablet resolutions. It's a nightmare.
So what breaks?
Common failures we see and that auditors look for include things like, one, CSS layering issues. The sticky banner fails to stay on top because some other page element, maybe a pop-up menu or a chat widget or a modal window, has what's called a higher z-index, and it just covers a warning.
Okay, so it gets hidden.
Gets hidden. 2, mobile scrolling glitches. On certain mobile browsers, maybe older ones, or during really rapid scrolling, the banner might momentarily disappear or flicker, or maybe fail to resize correctly if the orientation changes, pushing it partly or fully off screen. And 3, this is a sneaky one, loading delays. If the banner is loaded using JavaScript, maybe from a third-party script or a content delivery network, CDN, and there's even a momentary delay in loading, the main page content could render before the warning banner appears, even if it's just for half a second. That could be logged by an auditor's tool as a failure of instantaneous disclosure.
Wow. So if an auditor finds even one scenario, let's say it glitches slightly on an older version of Android using Chrome when you scroll really fast where that banner fails to stick perfectly just once, that's an immediate failure to disclose. That's it.
That is the severity of the standard being applied now.
Yeah.
Just the technical implementation has to be, for all intents and purposes, flawless, because the firm's legal defense hinges on proving the unavoidability of that disclosure.
So they need proof it worked.
Absolutely. If the firm gets audited, they need to be ready to prove, probably through technical logs, monitoring data, rigorous QA records, that the banner functioned correctly 100% of the time across all the relevant tested environments on all the relevant pages.
Which makes that compliance action VCCA suggests the rigorous testing of the whole account opening workflow and the disclosure presentation absolutely critical.
Yeah.
And continuous, right? Not just a one-time fix.
Continuous is the key word. You fix it, then you test it again after the next website update, and the next, and the next.
Okay, that puts immense pressure on operational maintenance. Just keeping the lights on technically becomes a compliance task. Now, let's pivot slightly. We've talked about the specific risk warning text and its display. Let's broaden out to the broader ethical mandate that governs all the other marketing claims. This brings in the Financial Consumer Protection Act 2022, FCPA, right?
Exactly. The FCPA acts as the sort of moral compass for the entire operation. It moves beyond just the technical disclosure requirements and gets into the core integrity of the firm's communications.
How does it do that?
It mandates, and this is a direct quote essentially, that financial services providers, FSPs, which includes these securities dealers, must treat clients equitably, honestly, and fairly.
Equitably, honestly, and fairly. Sounds simple, but...
But it's an incredibly powerful standard for the regulator. It allows them to challenge marketing that might be, technically true on some level, but is clearly designed to be intentionally misleading or to obscure the real risks.
So under this ethical framework, what specific kinds of marketing actions or claims are strictly prohibited?
Well, the prohibition itself is quite broad. It forbids publishing or advertising any information that may mislead, deceive, conceal, or give out false information.
Okay, mislead is interesting. It doesn't have to actually mislead someone.
Correct. The potential is enough. This is aimed squarely at that aggressive, often aspirational marketing language you sometimes see in the retail trading space. The FCPA doesn't just care if your risk warning banner is sticky. It cares deeply if the rest of your advertisement is actively undermining the message of that warning.
Right. You can't have the mandatory warning saying unlimited losses possible next to a headline screaming easy profits.
Precisely. That's a direct contradiction.
I often hear specific phrases mentioned in this context, things like guaranteed profits or maybe zero risk trading. Why do those particular phrases trigger an FCPA violation so quickly and obviously?
Because they constitute what the Act defines as unfair, deceptive, or abusive practices. And the reason is they are fundamentally incompatible with the potential for unlimited loss that must be stated in the required risk warning. It's a direct logical contradiction.
Makes sense.
If you guarantee profits on a restricted speculative investment, you are making an assertion that is, by the product's very nature, provably false. You can't guarantee market movements. So it directly conceals the truth about market risk. It's deceptive on its face.
So the standard then becomes about objectivity. The VCCA guidance mentions that all claims must be objectively verifiable. How does a dealer actually prove a claim is verifiable, especially for something maybe nuanced like historical performance data?
Verifiability really boils down to transparency of methodology and data. If a dealer wants to claim, say, 80% of our client trades were profitable last quarter.
Okay, a specific claim.
They absolutely must be prepared to provide the underlying data supporting that. They need to show the calculation methodology, how was profitable defined, what was the specific time period covered. And crucially, they must show that performance net of all commissions, fees, spreads, swaps, everything. The actual client experience.
Not just the gross figure.
Never just the gross figure.
Yeah.
And if the claim is more abstract, like, trade with the world's safest broker.
Yeah, how do you verify safest?
Exactly. That lacks objective verifiability. What metric are you using for safest? It's subjective marketing fluff, and it's likely to be deemed misleading under the FCPA. The regulation really insists on substance overhype. Claims need to be backed by hard, auditable facts.
Okay. That sets a really demanding continuous standard for all of the front-end transparency, the marketing materials, the website content.
Yeah.
But compliance, as we know, doesn't end when the client finally clicks sign up.
Not at all. That's really just the beginning of another phase.
Right. So we need to move seamlessly now from this public-facing advertising and disclosure, pillar one, into the core process of actual client engagement and protection, which introduces the requirements of the securities, conduct of business regulations, and brings us squarely into pillar three.
Yeah, Pillar 3 is all about the dealer's mechanism for fulfilling its regulatory duty of care to the client after they've expressed interest. This is really where the website stops being just a marketing tool
Uh-huh.
and transforms into a highly regulated compliance module. It's designed to ensure the firm is interacting with clients appropriately based on their assessed capacity for risk and understanding.
Okay, and the starting point for that, according to the regulations, is mandatory client classification. The rules demand categorization. Why is classifying clients usually as retail or professional so absolutely foundational to this duty of care?
Because it determines, essentially, the entire protective shield that the regulations mandate around that client. Well, retail clients are generally presumed by the regulator to lack the necessary depth of knowledge or trading experience, or perhaps the financial means to fully absorb high levels of risk.
Right, the average person on the street.
Basically, yes. And therefore, they receive the maximum level of regulatory protection. This includes things like having their funds segregated, stricter rules around marketing communications sent to them, and receiving the full suite of detailed disclosures and warnings.
Okay, and professional clients.
Professional clients, on the other hand, are typically those who meet specific, defined thresholds, maybe related to their financial portfolio size, their trading volume, or their professional experience in finance.
Right.
They are afforded less stringent protections because the presumption is they are capable of understanding the risks and essentially fending for themselves to a greater degree.
So the key point here is that the securities dealer can't just say, let clients self-select into the professional category because they want fewer protections or maybe access to higher leverage.
Absolutely not. The onboarding process itself must include specific, clear, and prompt questions designed to make this distinction based on objective regulatory criteria. The dealer has to assess them.
And prove they did it right.
Exactly. And the complexity here arises because the SD must not only classify them accurately based on the rules, but they also have to prove they've done so. And crucially, the systems need to react to that classification.
What do you mean, react?
This is the critical compliance action that VCCA highlights, ensuring the dynamic delivery of documents and disclosures based on that classification. If the system glitches and a client who meets the criteria for retail is somehow served the pared-down disclosures or terms intended only for a professional client,
Big problem.
huge problem. The dealer has fundamentally failed their conduct requirements. They've potentially missold the service and exposed themselves to massive regulatory and legal risk. The system literally has to act like a legal decision tree, branching the client experience based on their classification.
That sounds like a pretty significant IT and workflow overhead. You're essentially building systems that have to dynamically change the entire client onboarding experience based on the inputs to those classification questions.
It is significant, yes. There's no doubt. Furthermore, the dealer needs to clearly define the criteria they're using for classification, ensure those criteria themselves are fully compliant with the regulations, and meticulously log every client response and the resulting classification.
But if they get it right,
If the client classification is executed correctly and logged properly, then the dealer knows exactly what level of information, what warnings, and what protections are mandatory for that specific individual moving forward. It sets the stage for the next critical step.
okay, so classification sets the baseline level of protection. But the duty of care gets amplified, doesn't it, when we move to the real core of this pillar, the suitability and appropriateness tests, especially, as you mentioned, for those high-risk instruments or restricted speculative investments. How does the regulation define the dealer's heightened duty of care here?
Right. For these specific products, think CFDs, rolling spot forex, things with high leverage. The regulation moves beyond just the broad classification, Retail Pro, into a much more individualized assessment. The dealer has a heightened duty to determine if the product is actually suitable for that specific client.
Okay, suitable. How do they determine that?
The onboarding module, the questionnaire basically, must collect comprehensive and ideally verifiable information on 3 critical areas of the client's profile. These are their knowledge of these types of investments, their relevant trading experience, and their overall financial situation.
Knowledge, experience, financial situation. Can we maybe differentiate between suitability and appropriateness here? I hear both terms used. Are they basically two sides of the same coin, or is the regulation looking for two distinct checks?
That's a really good question, and the nuance is key. Generally speaking, appropriateness usually refers to checking if the client understands the product and its risks. That relates mostly to their knowledge and experience.
Okay, so can they explain what a margin call is? Do they understand how leverage magnifies both profit and loss?
Exactly. Do they grasp the mechanics? Suitability, however, is often considered broader. It checks if the product aligns not just with their understanding, but also with their financial capacity to bear potential losses and their stated investment objectives.
Can you give an example?
Sure, imagine a client answers all the knowledge questions correctly. They demonstrate they understand leverage perfectly. They pass the appropriateness test. But then in the financial situation section, they state they have minimal savings, high debt, and they're planning to trade using funds they might need for next month's rent.
Right.
In that scenario, even though they understand the product, it's appropriate in terms of knowledge, it's clearly unsuitable given their financial situation and risk tolerance. The potential negative impact of losses is just too high for them. The dealer has to satisfy both elements for these complex high-risk products.
Wow. Okay, so that requires the dealer to implement potentially quite sophisticated risk scoring logic based on the client's self-disclosed data. What kind of questions are we actually talking about to quantify something like financial situation in a way the regulator would accept?
We're talking quite specific questions. They usually need to ask about things like annual income range, estimated net worth, often excluding the value of their primary residence, and critically, the approximate percentage of their liquid assets they intend to commit to this type of speculative trading.
And the system can't just collect the answers.
No, it can't just be a data collection exercise. The system then needs to process those answers against predefined internal thresholds that the dealer has set, based on regulatory guidance and their own risk appetite. For instance, if a client's stated net worth is below a certain minimum figure, or perhaps if the intended investment represents an excessively high percentage of their declared liquid assets.
Like, say, 50% of their savings.
Exactly, something clearly imprudent. The system must flag them internally as potentially unsuitable. It shouldn't just take the answer at face value. It has to actively evaluate it against established risk parameters.
Okay. Now, here's where the technology seems to intersect dramatically with the compliance obligation. The unsuitability warning. You mentioned the system flags them internally. What happens next? If the system determines, based on the client's answers to those knowledge, experience, or financial questions, that these products are likely unsuitable for them, what is the mandatory requirement?
This is probably the most interventionist part of Pillar 3. The dealer must implement a mechanism that forces a hard stop in the onboarding process.
A hard stop.
Yes, and it must provide an explicit, undeniable warning to the client. The system has to generate a message that states clearly something like, based on the information you have provided regarding your knowledge, experience, financial situation, we have determined that these restricted speculative investments may be unsuitable for you.
And this can't be like a little pop-up they just click away.
Absolutely not. It needs to be presented with the same kind of prominence and conspicuous format as the main Pillar 1 risk warning we discussed earlier. Bold text, maybe borders, clear language, impossible to miss.
And crucially, what's required of the client at that point? Let's say they get this big warning, but they still want to proceed. They still want to trade. What happens then?
They must actively acknowledge that specific warning. This usually involves something like clicking a distinct checkbox or a button that explicitly confirms they wish to proceed despite the firm's assessment and explicit warning about unsuitability.
So they're overriding the system's recommendation.
Precisely. And that documented, conscious decision by the client to proceed against advice is ultimately the firm's strongest liability shield in this situation, because it effectively transfers the responsibility back onto the client. The firm can demonstrate that they fulfilled their heightened duty of care, they asked the right questions, they accurately assessed the client's risk profile based on the answers, they provided a clear warning when it was deemed unsuitable, and the client still chose to go ahead. It proves the dealer acted responsibly.
Okay, I'm going to challenge the premise here a bit, play devil's advocate. This sounds like a massive operational overhead. Complex questionnaires, risk-scoring logic, dynamic warnings, logging acknowledgments. Why wouldn't a dealer just, try to subtly structure the questions or the thresholds to ensure almost everyone passes? Isn't this requirement just a way for the regulator to impose an expensive, complex, and ultimately perhaps ineffective screening process on the industry?
It's a fair challenge, and yes, it is expensive and complex to implement correctly. No question about that. But the calculation dealers need to make is comparing that implementation cost to the potential cost of noncompliance.
Which could be.
Exponentially higher. Think about it. The regulator is essentially forcing the SD to meticulously document its diligence during onboarding. Now, fast forward. Imagine a client loses a significant amount of money trading these complex products. They later complain to the regulator or sue the firm, claiming they were misled or pressured or sold a product that was totally inappropriate for them.
A common scenario, unfortunately.
Very common. In that situation, the firm's very first line of defense is going to be that suitability assessment log from the onboarding process. If that log clearly shows the client was objectively flagged as potentially unsuitable based on their own answers, received the explicit warning, and then actively acknowledged that warning to proceed anyway.
The firm's case is much stronger.
Dramatically stronger. The firm has virtually eliminated or at least significantly mitigated their liability for mis-selling or providing inappropriate advice. Without this documented process, the firm is wide open to claims of aggressive or negligent sales practices, potentially falling foul of the broader principles in the FCPA we discussed earlier. So, viewed that way, the cost of implementing this suitability framework isn't just overhead. It's actually a form of insurance.
An insurance policy against potentially crippling legal fees, regulatory fines, and reputational damage.
Exactly. Compliance here, while burdensome, provides a crucial defensive shield.
Okay, that perspective makes a lot of sense. So pillars 1 and 3 really define that dynamic interaction, the front-end marketing messages and disclosures, and then the subsequent onboarding engagement client assessment. But a successful audit, as VCCA points out, requires more. It requires that the static foundational documents and the legal identity underpinning the entire operation are also flawless. Let's shift our focus now to the other two pillars, pillars 2 and 4, which address these more operational and legal necessities.
Right. These next two pillars, Pillar 2 and Pillar 4, cover the, let's say, less glamorous but utterly critical infrastructure of compliance.
The plumbing.
Kind of, yeah. They demonstrate whether the firm actually has solid internal governance in place and maintains a transparent, verifiable legal identity. And interestingly, these are often the areas where seemingly small technical failures can lead to massive compliance penalties.
Okay, let's start with Pillar 2 then. Mandatory operational policies and disclosures. What's the fundamental mandate here regarding the availability of all those legal and operational policies?
The core mandate is really twofold. First, all the key policies governing the client relationship, the rules of the game, essentially must be easily findable on the website.
What does easily findable mean in practice?
It means no more burying them 5 clicks deep in some obscure corner of the footer menu. They should be logically placed, maybe under a clear legal or document section, readily accessible from main navigation or the footer.
Okay, so findable. What's the second part?
The second part is critical. These policies must be fully accessible to download, usually as PDFs, before the client signs up, before they commit.
Before they even open an account.
Yes. The prospective client must have the ability to review the entire contractual relationship, all the terms, all the conditions, all the policies, before they click I agree or submit their application. Full transparency, pre-commitment.
Which specific policies are we typically talking about here? It's more than just the standard terms and conditions, isn't it?
Oh, yes, definitely. We're talking about the full suite of core operational documents. This typically includes the main client agreement, or terms and conditions, of course, but also things like the order execution policy.
Which explains how trades are actually handled.
Exactly. Best execution principles, venues used, etc. Then there's usually a conflicts of interest policy, outlining how the firm manages potential conflicts. Very importantly, the complaints handling procedure, how a client can formally complain and how the firm will deal with it. And then all the various privacy policies and data protection notices, especially with GDPR and similar regulations globally.
Yeah, quite a list.
It is. Each of these documents defines a crucial facet of the client-dealer relationship, and the regulator needs absolute assurance that prospective clients can see all of this before they enter into that relationship.
Now, this accessibility requirement, the need for them to be downloadable before sign-up, introduces what the VCCA source calls the practical trap, which is...
the broken link audit. It sounds almost trivial, doesn't it? A broken link on a website.
Yeah, that was all the time. Annoying, but...
But in this regulatory context, the FSA treats a broken link leading to a mandatory policy document as a potentially serious compliance failure. It's not just a technical glitch.
How can a broken link be that serious?
Because it's viewed as constructive concealment. Think about it. If the link on your website that's supposed to lead to your official complaints handling policy results in a 404 not found error, then from the regulator's perspective, you have effectively failed to disclose the mandatory procedure for client redressal at that moment. The information wasn't accessible as required.
Wow. Okay. So what's the required action?
The rule, or at least the strong interpretation and expectation, mandates that firms must conduct a thorough broken link audit monthly.
Monthly. Just checking links.
Yes, and it's not just about clicking the main link in the menu, say legal documents. It's about systematically checking every single download link for every required policy document, usually PDFs, and checking any crucial hyperlinks within those legal sections. It has to be a continuous, documented process.
A monthly broken link audit. Honestly, that sounds like an incredibly tedious, potentially expensive bureaucratic headache, especially for a complex website. Is there really no wiggle room on that frequency? Why mandate monthly checks? Why is continuous operational maintenance like this a specific regulatory requirement?
The frequency, that monthly requirement, is really a testament to the regulators' intense focus on proactive governance and operational resilience. They understand that websites are dynamic, things change.
Content gets moved, files get renamed.
Exactly. Link rot is incredibly common, especially after website updates, platform migrations, or even just routine content changes. By mandating a monthly check, the FSA forces the firm to allocate specific, dedicated, and importantly, auditable resources to the continuous maintenance of accessibility for these critical documents.
So they need proof they're doing it.
Absolutely. If the firm gets audited on this point, they will likely need to present a log or records of the broken link audits they've conducted over, say, the previous 12 months. That log should detail when the checks were done, what findings, if any there were, and the dates the issues were remediated.
And a gap in that audit log.
A gap, or evidence of consistently failing links that weren't fixed promptly, would itself be seen as a sign of weak internal controls and poor governance. It shows a lack of attention to basic compliance hygiene.
So the takeaway here is that compliance isn't just about having lawyers draft the right policies. It's about the relentless, sometimes boring, technical upkeep required to ensure those policies are actually available to the public 24/7. That's quite a profound operational shift.
It truly is. It really reframes operational compliance. It becomes an ongoing IT security function, a web maintenance function, not just a purely legal or compliance department task siloed away somewhere.
Okay, that covers Pillar 2. Let's transition now to the final pillar, Pillar 4, which deals with statutory disclosures and legal clarity. This sounds like it's all about the firm's public declaration of its official legal identity. And you hinted the requirements here are also exceptionally rigid.
That's right. This pillar is fundamentally about ensuring the client knows exactly who they are contracting with, legally speaking, and verifying that the entity they're dealing with is actually authorized by the FSA to conduct that specific securities business.
What's the main risk the regulator's trying to mitigate here?
The primary risk is firms operating under various trade names or brands that aren't officially linked to the licensed entity. This can obfuscate the true regulated entity, making it harder for clients and regulators to track accountability.
Okay, so let's focus on the licensing identity requirements first. What must be true about all the trade names, the brand names, the domain names that a securities dealer uses on its website or in its marketing?
The law demands absolute verifiable linkage. Every single approved trade name, every brand name used for marketing, and every domain name associated with the dealer's public-facing operations must be explicitly listed on the firm's official FSA license.
Listed on the license itself.
Yes, and consequently, because the public can view the license details, those approved names must also appear on the publicly accessible FSA public register. This effectively eliminates the use of catchy marketing names or website domains that haven't been formally vetted and approved by the regulator as being associated with that licensed SD.
So if the website is, say, besttradesEver.com.
Then besttradesEver.com as a domain or Best Trades Ever as a trade name must be officially approved by the FSA and documented on that specific SD's license record. No exceptions.
Okay, crystal clear. And then what are the specific actionable display requirements for the website itself? What information must be clearly visible, usually in the footer or maybe a dedicated legal or about us section?
Clarity here needs to be absolute and easily found. The website must clearly and conspicuously display 3 specific pieces of information, typically grouped together, most often in the footer of every page.
Okay, what are the 3?
1. The full registered legal entity, name the exact name that appears on the FSA license certificate. No abbreviations unless the abbreviation is the registered name.
Got it. Do.
2. The firm's exact FSA license number. This usually follows a specific format, like SD0XX or similar.
And 3.
3. The firm's official registered address, as recorded with the FSA and the company registrar.
Why is displaying that specific FSA license number, the SD0XX, so critically important?
Because it provides the client, or any interested third party, with the instant ability to independently verify the firm's authenticity and regulatory status. A potential client can take that SD0XX number they see on the website footer, go directly to the FSA's official website, look up the public register of licensees, enter that number, and instantly confirm that the entity presented on the website corresponds exactly to the entity that is genuinely regulated by the authority for those activities.
It's the ultimate transparency check.
It absolutely is. And any discrepancy here, say, the legal entity name displayed on the website is slightly different from the name associated with that license number on the FSA register, that's an immediate, high-severity compliance failure. It suggests something is wrong, potentially deliberate obfuscation.
So if we look across these two pillars, Pillar 2 and Pillar 4, we really see the foundational bedrock being built, don't we? The firm has to ensure its operational rulebook, its policies are perpetually accessible, Pillar 2, and its core legal identity is flawlessly transparent and easily verifiable by anyone, Pillar 4.
Exactly. These requirements, taken together, move way beyond just internal self-governance. They actively serve the larger regulatory ecosystem by ensuring public confidence, making due diligence easier for clients, and simplifying verification for the authorities themselves.
It really underscores the point that the website isn't just an endpoint for marketing anymore. It's become the public-facing regulatory control panel for the entire client lifecycle and the tangible proof of the firm's legal integrity.
Yeah, and if you synthesize all 4 pillars we've discussed, this super visible sticky risk warning from Pillar 1, the detailed suitability tests and client classification from Pillar 3,
Right.
the guaranteed accessibility of operational policies from Pillar 2,
Yeah.
and that transparent, verifiable legal identity demanded by Pillar 4, the overall objective that emerges is crystal clear. It's about building a demonstrably, proactively audit-ready structure.
Not just compliant on paper, but audit-ready in practice.
Precisely. And the FSA's trajectory, particularly with the new 2024 regulations, signals very strongly that substance, governance, and robust investor protection are now the absolute paramount concerns. They're not just suggestions anymore.
Why is this meticulous adherence to these, frankly, highly prescriptive and detailed rules mandatory now? You mentioned the new regulations, but what really shifted in the regulatory environment to make them enforce these minute details with such apparent rigor?
I think it's a combination of factors. Partly, it's the evolution of regulatory technology and capacity. Regulators themselves have better tools now to scrape websites, check for compliance automatically, log failures.
RegTech.
Exactly. But more fundamentally, it's about regulatory intent, strongly signaled by the new 2024 advertisements regulations and the underpinning VCCA. Previously, regulators might have focused more on broad principles. Are you treating customers fairly? Now, they have equipped themselves with very specific surgical criteria that allow them to identify immediate, objective, non-compliance findings.
So less room for interpretation or argument.
Much less. The securities dealer can no longer really hope to find an issue during an audit and then negotiate a remediation plan afterwards. The expectation now is that they must be able to prove continuous, near-perfect compliance beforehand. The focus has decisively moved from reacting to non-compliance discovered during an audit to preventing it through these preemptive, mandated structural controls on the website.
Okay. Now, compliance, as we know, is traditionally viewed by businesses as, well, a cost center, a drag on resources, maybe even on profitability. But you and the VCCA guidance seem to argue that this incredibly rigorous adherence, this high bar, can actually be turned into a competitive advantage for the securities dealer. How does that work? How does this high barrier to entry actually benefit the firm that embraces it?
It works by creating a powerful filter in the market and by becoming a signal of quality and trustworthiness. Think about it. A firm that successfully, flawlessly implements things like sticky risk banners across all devices, conducts and documents monthly broken link audits, runs complex suitability questionnaires with appropriate warnings.
Demonstrates competence.
It demonstrates significant operational maturity, technical capability, and a serious commitment to regulatory integrity. These are things that, frankly, less scrupulous, less well-capitalized, or less operationally sophisticated competitors simply cannot match or can't match consistently.
And who does that attract?
It naturally attracts the more sophisticated clients. We're talking about potentially institutional partners, high net worth individuals, experienced traders clients who themselves value regulatory certainty and operational stability.
Because those sophisticated clients, they're doing their own due diligence, aren't they? They're not just looking at spreads, they're looking for these markers of compliance and stability.
Exactly right. When they investigate a potential dealer and they see a firm that is clearly going above and beyond the bare minimum legal threshold that has these robust systems visibly in place, they perceive lower counterparty risk, lower operational
So the
risk.
compliance headache transforms.
It transforms into a powerful marketing narrative. It allows the firm to say, implicitly or even explicitly, we are one of the safest, most reliable, most transparent places for you to conduct your business and hold your capital because we take regulation extremely seriously. It shifts the firm's competitive edge away from just competing on price, like low spreads, towards competing on maximum regulatory security and operational integrity. In a crowded global financial marketplace, that's a potent differentiator.
It really moves the sales conversation away from just the inherent volatility of the market itself, towards the perceived stability and reliability of the institution facilitating the trades.
Precisely.
And as we note again the source of much of this intricate advice, Victoria Chartered Certified Accountants VCCA, it seems clear that they advocate for, and likely provide, a very integrated approach to tackling this whole challenge, right? It's not just about the website in isolation.
Absolutely, and that holistic view is essential. You can see it in the breadth of services. VCCA offers things like audit and assurance, bookkeeping and accounting, advisory services including policy formulation, and tax services. They clearly understand that these website rules aren't just isolated legal requirements you hand off to the web team.
How are they connected?
They are intrinsically linked to the firm's internal policies, which VCCA helps formulate, its financial record keeping and health, which they audit and manage, and its overall demonstrable audit readiness. For example, if you consistently fail Pillar 2 by neglecting that broken link audit we talked about, that's not just a website issue, it's a governance failure. It indicates a breakdown in internal controls, and that will likely show up as a finding or a point of concern in your main statutory audit and assurance review conducted by a firm like VCCA. The financial health, the operational integrity, and the regulatory presentation of the firm are completely inseparable in the eyes of the regulator.
So the ultimate lesson here, for any securities dealer listening, is that their public-facing website must be treated not as a standalone marketing asset, but as a fully integrated living extension of their core legal, compliance, and governance structure.
Precisely stated. The goal isn't just to pass the next audit, it's to establish the long-term viability, credibility, and trustworthiness of the entire business model by actively building that trust based on verifiable legal clarity, robust operational processes, and transparent risk communication, all documented and visible right there on their digital interface. These securities dealers are not just meeting regulations, they're actively ensuring their future regulatory standing and market reputation. #tag outro.
Well, this has been an incredibly detailed deep dive. We've really dissected the 4 mandatory pillars that now define what audit-ready marketing truly means for securities dealers in this evolving regulatory landscape. Just to quickly recap the key takeaways for you, our listener.
Yeah, good idea.
We started with Pillar 1, that hyper-specific, unavoidable risk warning. Remember, conspicuous, bold, bordered, and sticky, and containing that absolutely critical phrase about potentially incurring unlimited losses greater than the amount deposited, all enforced by the zero-tolerance ethical standards of the FCPA, which strictly bans any unverifiable or deceptive promotional claims.
Can't stress that enough.
Then we move to Pillar 3, focused on conduct of business. This demands mandatory, accurate client classification, sorting clients into retail or professional categories based on objective criteria, and implementing those complex suitability and appropriateness tests, especially for the high-risk products, which absolutely requires the system to issue an explicit, client-acknowledged unsuitability warning if the client's profile indicates the products might pose too much risk for them.
That warning and acknowledgement step is crucial for liability.
Then we cover the foundational elements. Pillar 2, operational policies and disclosures. The key here is that all those essential policies must be easily accessible and downloadable before a client signs up. And compliance isn't static. It's enforced by that requirement for a regular, likely monthly, broken link audit to ensure continuous accessibility.
The mundane but vital maintenance.
Exactly. And finally, Pillar 4, statutory disclosures and legal clarity. This is about ensuring complete legal integrity, Making sure the website prominently displays the full, correct legal entity name, the precise FSA license number, like SD0XX, and the official registered address, and verifying that every single trade name or domain used is officially FSA approved and listed on the license.
Get those details wrong and you fail immediately. The overarching message, really, for the entire industry listening is crystal clear. Don't wait for the auditor to show up and find your noncompliance. You need to build your website, your processes, to be demonstrably audit-proof starting today.
Absolutely. And as we close out today's discussion, let's try and connect this very granular, micro-level compliance we've been discussing, you know, sticky banners and link audits, to the much bigger picture. The macro-level regulatory image and reputation of Seychelles itself on the global stage. These incredibly rigorous requirements we've detailed are, arguably, driving an unprecedented standard of operational integrity for licensed firms. Now, we know that, like many financial centers, Seychelles has sometimes faced external scrutiny and has had to actively engage with international bodies regarding transparency concerns, including, for instance, past mentions on watch lists like the EU blacklist for tax purposes, although that's a separate issue from financial services regulation per se.
That's right. And what's fascinating here, I think, is how every single technical and procedural detail we've discussed today, from that mandatory sticky risk banner visible on every page to the auditable suitability assessment log for every new client, contributes directly and tangibly to the nation's broader integrity narrative. Well, this kind of highly prescriptive, verifiable website compliance demonstrates to international regulators, correspondent banks, and potential investors that the Seychelles authorities are genuinely serious about enforcing transparency and robust investor protection standards. It shows they're moving far beyond just having rules on paper. They're demanding auditable proof of compliance in practice right down to the digital interface. This kind of demonstrable effort is absolutely critical for maintaining international investor trust and progressively enhancing the jurisdiction's reputation as a credible and well-regulated financial center on the global stage.
Which raises one final, perhaps provocative, question for you, the listener, to consider. If a jurisdiction like Seychelles mandates that good governance and transparency must start right at the digital doorstep, with every pixel, every link, every disclosure on a securities dealer's website being subject to intense regulatory scrutiny, what does the demonstrable perfect compliance status of that website signal, not just about the firm itself, but perhaps about the future stability, reliability, and long-term regulatory trajectory of the jurisdiction as a whole? Something to think about. Thank you so much for joining us on this deep dive into audit-ready marketing for securities dealers. We sincerely hope you can use this knowledge, whether you're a dealer, compliance professional, or just interested in financial regulation, to assess practices and stay ahead of this demanding curve. We'll see you next time on the Deep Dive.